Welcome to TMS Insights. Jeremy Hook and Ben Clark bring you our second edition for the month of August as we're in the middle of reporting season. We wanted to bring you some of the reports that have already happened, some updates as news is thick and fast on the ground. And Ben, reporting season, though we've got more of the companies to report, we've had some significant ones already, and some pretty good ones.
Yeah, look, it's been a bit patchy, I'd have to say, and we've seen some pretty violent sort of share price movements on the upside and on the downside, which sort of tells you that the market isn't too sure, sort of what to expect. But first one off the bat, which was pleasing, was Cochlear, which has certainly been a more challenging investment, you'd have to say, in the last year or two. But they reported a very strong pickup in sales in the second half, and that really sort of wrong-footed the market that was expecting that weakness to continue. So we saw a good jump in Cochlear shares, and if we can continue to see that sales momentum push into this current financial year, hopefully that share price should stay well supported.
So that was a good one for one of the bigger healthcare stocks on the market. Another one reported pretty well, but its share price reaction wasn't as good, was ResMed. So that was a good result though, basically?
Yeah, it was a good result. I think the company has a big product pipeline that's being rolled out this financial year. As they got toward the end of last financial years, you often see everyone put their orders on ice as they waited to buy the new products coming out. The market initially sold off, but then actually came around to the fact that this year should be quite a strong growth year. In fact, Mick Farrell on the call said, this is the most encouraging year coming up I've seen in the 14 years I've been at the company. And we're seeing quite a decent sort of pick back up in that share price. So these healthcare stocks starting to hit their straps.
Yeah, so that's good news. I guess elsewhere, we watch a number of the big, almost internet sellers, and as people will know, Seek and Car Sales are two of our favourites. One that we've stalked for a long time and been interested in buying is REA, or realestate.com.au, and that one reported, and Ben, it pulled back a little bit. It's getting interesting, isn't it?
It got hammered. Had a good jump back up yesterday, of course, though. But look, REA has always been a stock I think we've both struggled to get our heads around in terms of what a brilliant business it is, and we see that firsthand. But we also see the
valuation
issues
has been an issue for us.
Versus valuation, trading on a very, very high PE, and it's hard to sort of warrant paying that. But it has come back recently. There's this big sort of there's this big thing happening with the real estate agents who aren't happy about the way that they're charging. That could create an opportunity in the next 6 months potentially, as we think it won't have a long-term sort of impact. And JB Hi-Fi, they reported yesterday.
Look, and JB Hi-Fi updated the market a couple of months ago, so we weren't expecting really much in the way of a surprise. We like those earnings updates because it removes one element of the risk in investing and knowing whether we've got a good price for the stock. But there are a couple of things they announced in the announcement yesterday that caused the market to sell the stock off. We still very much like JB Hi-Fi, but slower tablet sales seems to be the major factor. And also as they roll out into that new JB Home product, that's going to be interesting to see just how they get traction. And we know there's nervousness in the market about Woolworths with their Masters stores and the slow development and cash flow there. So this is just an issue, but I think JB Hi-Fi is still a very interesting stock, has a number of the things we like. It's just, again, getting it at the right price. And these stocks sometimes can get a little bit expensive in the short term. So there have been some of the bigger results in the industrial side, but one that was a good one we must mention is Rio. And that was a good set of numbers.
Because one issue in our market is a lack of earnings growth. And ironically, we actually saw strong earnings growth from a resource stock, which is in a sector which has been really beaten up in the last couple of years. But Rio actually grew earnings by 21% for the second half of the year. And I think it really highlights what's happening right across the market, Jeremy, that we see when we're speaking to these companies is cost cutting is still rampant, and a lot of the earnings growth is still being driven by cost cutting as opposed to revenue growth. And you'll get no greater example of that than Rio, which was selling all of its products for much lower prices than it was, say, 6 or 12 months ago, mainly, of course, the price of iron ore. But it's been able to take so many costs out of the back end, it's still generating profit growth, which is good to see, but of course that you can't keep doing that forever.
And the key takeaway here is, while that was a good set of numbers as standalone, we think the price isn't necessarily attractive at all at the moment, and it's not something that we would actually recommend loading up on, but it is something that we should note in this reporting season.
Definitely.
The other things that we need to talk to you about is Investra, which has actually now finally succumbed to takeover from CK under a contested bid with APA, but this has worked out really well, hasn't it?
It has, and I think we were sort of saying there's been, since we've been doing these video diaries, there's been 2 stocks that we've really sort of recommended on the video. Car sales, of course, when it got close to $9, and Investra. And since mid-March, when we put out that sort of buy recommendation to clients, it's returned 20.7%, including distributions. Of course, there's quite a good gain to be made also in a very much shorter period of time if you wanted to be a little bit more active in it. But just to let clients know, that will go through very rapidly now. Cash will be paid back into bank accounts on the 29th of August. And hopefully that'll give us some money to look at other companies through reporting season to invest in.
Yeah, and that was a good one. And like we said, the method of this this video on the TMS Insights is to provide ideas like that to the clients. So please, if you did get on board that, you've done well, and we want to bring you more of the same as these videos roll. But just to wind up, we want to talk, Ben, as we are in the middle of, things have changed in the last couple of weeks in a macro setting. We know we had a big headline unemployment rate of 6.4% last week. That was surprising, and a number of the settings in the global macro environment have changed a little bit too.
Absolutely. I mean, we're seeing a lot more talk. The quantitative easing thing in the US is now in the back sort of mirror.
Yeah, not an issue.
And now everyone's looking at when are the US going to start lifting rates. This sort of ZIRP or zero interest rate policy soon will also start to get unwound. I think we both agree that it will happen very slowly, and there won't be a rapid sort of rise in rates in the US, but the market is starting to focus on that more now. Of course, we've got the big geopolitical events in the Ukraine and Iraq, which are, you know, sort of rattling confidence a little bit, but I would have to say the markets have overlooked them generally quite well. And you know, the unemployment number, I think locally that's probably got the biggest implications for us in that A, now there's quite a few economists calling for another rate cut, and B, rates are not going to go back up anytime soon.
And that changes all the settings when we're talking about the shares that we're looking at and how we see them, and it underpins the market to some extent, you know, a healthy and strong bond market, which we're likely to see for some time. So.
Yep, and I think also it really highlights what you've seen globally in equity markets. The US now has a lower unemployment rate than Australia does.
Amazing.
And which, who would have guessed that a few years ago?
Yeah, exactly. Well, that's all we've got time for today. We'll come back to you next at the start of September, and we're wrapping up what hopefully continues to be a good reporting season. Thank you.